Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we make investing fun, simple, and real. I'm joined today with my cough, so I hope you'll all excuse that. Corey, Halliday, Noah Davidson, thanks for coming, guys. Today we're going to talk a little bit about current events, what we're going to call the eye of the storm. We've had some tariff stuff shake up the market, and with some delays or pauses or whatever, we've settled down a little bit, but as Noah was saying before we started the podcast, we're waiting with bated breath. So awesome stuff. Like and subscribe, hit your notification bell so you know when new episodes been released, and most importantly, make sure, if you haven't done so, go to yourinvestingclass.com. We've got free stuff there, life-changing stuff. In fact, right now it's not a class, it's actually a free ebook. And so get there and take advantage of that, because it's designed for people that want to take action and actually do some things to build a wealth blueprint to take you from where you are now to wherever your investing dreams may reside. It's a great vehicle for that first step and to build that blueprint. Go check that out at yourinvestingclass.com. With that, let's start with Noah with brief introductions.
Well, Andy, my wife and I, in our weekly meeting this week, reviewed our last will and testaments. And so I'm ready for anything that's coming down the pipeline. My name's Noah Davidson, and I've been trading and investing since the late 90s. I've been hanging out with people like Andy and Corey for the last 20 some odd years. And so I think I've earned the right to be here through experience and through a hard fought study. And so I'm excited to help people navigate these turbulent times.
Great to have you, Noah. Corey Halliday, ladies and gentlemen.
Yeah, excited to be here. I got started in the markets around the same time. We've been doing this, each of us, for 25 plus years. And, the markets, even though they change over time, the more they change, the more they stay the same. And we've all been through these eye of the storms, the domino effect where something goes wrong and then it triggers something else. And then there's ramifications for that. And so that was really my background as a Series 4 option principal, was in terms of risk management, hedging, protecting, knowing how to basically make the best of a bad situation.
I was so grateful for the last 2 weeks and the letters. We always get letters, but we had a wave of feedback coming in, because we don't like to say we told you so, but we told you so.
Yeah. It's like we almost saw this coming.
Well, last summer, and I had, most people are pretty good because they know, we're a business, and we do the podcast so people can get to know us and feel comfortable in becoming a student. Ultimately, the ideal scenario is to become a student of the Cashflow Academy. So last summer, we started to see, especially Corey, when Corey starts to text about bearishness,
that's a change.
That gets everyone's attention. And we did our armor class, and we really put it together quickly. I wouldn't say we threw it together, but we did assemble it quickly for advanced risk management opportunity readiness. We said we don't know if it's going to be a year, 2 years, 3 years, but we saw some volatility coming, and we felt we should equip people to know how to do some advanced risk management and seek opportunities. So I was grateful for the opportunity to, I went delta neutral during that time. So I kicked my feet up and, went flatline, kept all my dividend income, kept all my premium that I would sell premium, and just enjoyed that. Wasn't so much opportunistic at the bottom for me at the big bottom day, because I still think, I think Warren Buffett does, I still think there's a lot of room to fall, and I just didn't see us get low enough to see big value come in yet. So I did not go out and buy the dip in any way, shape,
grand
or form.
fashion.
Well, I bought a little bit of the dip, but I've already closed some of those positions out.
Apple was tempting. Apple gets to 170. That's a real tempting price at Apple. But even then, their PE multiple is still pretty high against the industry, and I just think we're going to have better opportunities than that. So anyway, thank you for everyone that wrote us letters. We had people that calculated what they would have lost up and down in that thing, and we had some of the best results we've seen in the history of the Cashflow Academy because of those people that were in that armor class. Yeah. So congratulations to all of you that were in that class. Those of you that know for sure. But with that, Noah, you mentioned the phrase "eye of the storm." So, talk a little bit about that, if you would.
The market turbulence is kind of calmed down at the moment. We had that big precipitous panic, and then we saw the market recover off of early optimism that things might be moving in the right direction towards getting some trade deals done, and it's rallied right back up into what we call, in technical terms, the kiss goodbye zone, where the old support price threshold, it's kind of testing that zone before.
New resistance possibly.
And it becomes an area where the market's it's kind of paused. And the last couple of days, it's been eerily quiet after a lot of turbulence. And so I'm looking around, I'm thinking, well, I don't think the storm's over. I think that this is just the eye of the storm. And who knows what's coming? Because, I don't think anybody knows, because there's just so many complex moving parts and so many different players that could potentially influence the outcome. And I think everybody's just kind of waiting for the next shoe to drop. We're also heading into earnings season. So all these corporations, and they might have lowered guidance. And like I just saw recently, like JP Morgan lowered futures outlooks on energy because they think we're heading into recessionary times, which means consumption will drop. And so they've downgraded energy sectors. So then I'm watching that. I'm like, okay, but then I'm also seeing the very first earnings reports coming out, and some beating expectations, and it's just very early in the game. So the next couple of weeks are going to be telling, and then who knows what's going to happen with the trade war. It's going to be trade talks. We'll lower the rhetoric just a little bit, but it's up here, and we're going to try and bring it down here, but that's kind of where it's at.
Yeah, the markets are kind of interesting that way. When you're in a bear market, the cycle sort of shifts, where now all of a sudden we'll have fewer down days probably than up days, but the down days become sharper and steeper. And so it's not uncommon to see a market melt down for 7 to 10 days and then maybe go through a 14, 18 day correction. And so you're like, well, it spent more days going up, but it couldn't get back to where it was, and then you roll over again.
It tends to come down really, really hard, and then it rips back up, and then peters
flat
out,
lines,
and then drops again.
And then falls again. And that's kind of that domino effect. And the weird thing is, the market's down 20% off its highs. So S&P, NASDAQ both triggered kind of that bear market. Hey, we're in a bear market territory. And you'd think, well, this is where PEs and all those things should look really attractive. But they really don't on a longer term scale. We haven't gone through enough discounting, and it kind of speaks to how perhaps overvalued we were as a market going into this. And then the other tricky aspect of it is PE ratios are tricky because a lot of times they're at their lower points at the tops. Because if you think about the economy, the economy's been very strong. Corporations are earning more, so the E part of the PE is bigger. And then you go through a recession, the E starts to shrink. And so now you look more overvalued as you're getting lower and lower because the E's shrinking. So the P's going down, prices are getting discounted, but you're losing the E as well. So it's a tricky thing where, like, if you looked at just pure PE ratio by itself, it's not always the best gauge because it can look too attractive at the highs and then look ugly at the lows, but the E's about to expand. So I always focus on our
value. What about book value?
Book values, and then also thinking about where the E is going is important, right? It's not just about the PE ratio. You want to think about, well, where are earnings going? And I think I can confidently say that most economists, that are projecting the E, are going to say, okay, it's less than what it was a few months ago. The E is going down across the board. How bad will it get? How much will the economy slow down? Now, that's debatable, but the E is going to shrink in the S&P 500, and that's a problem for the markets.
So some lowered forward-looking guidance
exactly.
is probably what we could expect.
It'll be interesting to see how those earnings shape out because there's still a lot of money out there.
Oh, yeah.
I always I'm kind of a boots on the ground type of guy, and I'll go to a restaurant and people are just spending money right and left. You notice the inflation and going out to eat, and you go to the mall during the day. I thought, everyone must be out of the rat race because no one's at work. And so there's still a lot of money there. But the other question I have is Well, maybe talk about this after break, but I'd like to talk about the Fed and the decisions they have to make, because Noah, if we have, if the energy people are thinking recession, that puts the Fed in a very difficult spot to maintain price stability, and their dual mandate of employment and price stability becomes opposing very sharp very quickly. So
can they thread the needle? Stay tuned and find out next.
Oh my gosh. So with that, we'll cut to a commercial break. When we come back, we'll answer the question. So we'll be back in a moment.
They make different topics that could be complex very simple. You're going to learn at your own pace. The more that you want to learn, the more you can learn. It's been amazing for me personally, as well as me taking the subject matter and teaching it to my children. They're all very passionate about what it is they're teaching and how they teach it, and it just comes across as so genuine. If it's something that you're interested in, then certainly they're the best teachers that I've run across in terms of teaching fiscal education.
Welcome back to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing a lot of fun. We make it simple and certainly real. Joined here with my good friends Noah Davidson, Corey Halliday. We left going to the break talking a little bit about the Fed. And the Fed is always an interesting thing to match up their policy. If you were to look at the booms and busts, and employment, how that stuff works, the SOM indicators. The SOM rule is kind of an interesting thing to look at. But here you've got the Fed saying, okay, we haven't reversed inflation. We haven't had a de-escalation in it. We've stopped its acceleration, but the grocery store is still painful for people relative to where it was. So they really can't have any more inflation. Yeah. They can't have that. And on the other side, I'm going to be watching the SOM rule because that thing's been pretty resilient in its ability to predict recession. And I think you got to keep your eye on employment. Now, we had a pretty good employment number last time, and so how do people react to Fed if they do a little easing? Because normally the market would say, a little bit of cocaine, man. Let's get some drugs in here. But they might look at it and say, okay, the Fed is only going to ease now as if we're in serious trouble.
Yeah, and that's the negative aspect of it, is usually when the Fed is cutting rates, the stock market's not doing really, really well because they're reacting to something, right? Yeah. Generally speaking, they're trying to increase medicine. Yeah, they're trying to increase economic activity, and there's something that's stalling out, and they're, we're in a deflationary environment or something, and they're not worried about inflation. But the Fed's in a tricky spot right now because they've seen inflation get out of control. They screwed that up, and they do not want to screw up inflation again. So my opinion is that they're willing to sacrifice some job losses to make sure they don't have a double screw up on inflation. They'll let that unemployment rate rise to 5% before they'll really go aggressively on the scale of cutting rates and risking inflation having another bounce back, because that was, when inflation was running 7, 8, 9, 10%, they really screwed that up, and they admitted it. Whole transitory.
They went from transitory to sticky.
Yeah.
Transitory to sticky inflation.
They at least admitted it was not transitory. That they. Yes. Yeah. I don't think they'll ever say, we screwed that up, but they certainly were at least admitting that was a mistake.
Well, it's interesting. So I kind of regularly monitor the Fed Watch tool, the Chicago Mercantile Exchange.
Hasn't been it's usually 99%, 1%, but it's been a little bit.
So that upcoming meeting, the March meeting, they're speculating that it'll be the probabilities increase to 20%, 19-20%. And that's a constantly moving target.
Yeah.
And in the recent Fed speeches, Powell's been pretty stalwart. Stay the course. Inflation's a concern. It's our primary concern. We're gonna not flinch. But will the Fed flinch? I don't know. I think that's a big question. I think if the market drops hard enough, it might trigger a response for a Powell put, so to speak, where they do a quarter point cut. And if that doesn't solve, because that's the thing, is if you kind of look back at previous recessions and market corrections and economic catalysts, the cutting rates, they start a little bit early on.
But you never see the Fed. Look, you've never seen the Fed cut a quarter point and say, oh, okay, that fixed everything. If you look at the trends, they go boom, 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 and then they have mountains.
Yeah. Well, they go boom, 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 pause, pause. And they kind of wait for it to break.
Look at these sound effects.
I've got nothing but sound effects.
But they go in trends. Like they're in a rate, right now they're in a rate cutting cycle.
Yeah.
So that is the cycle that they're going through. But here's the thing. I think the bond market called Trump's bluff. The bond market, historically, when the stock market falls 20%, bonds are a safe haven. You rush to U.S. government debt. And so that was the initial reaction, was U.S. government debt, bonds went up and yields went down. And I think this was part of the Trump administration's idea is, hey, this yields will go down. We'll sacrifice stocks a little bit because we have to refinance all this debt and we'll be able to pay lower interest rates. And then lo and behold, I think apparently Japan and other countries started selling some U.S. government debt. All of a sudden, the bond market fell over and yields shot up. And yields are now higher than where they were before. And that was not expected.
Yeah, and if by bond market, you really mean China. China started liquidating.
Let's talk
about liquidating. Yep. But I guess the studies are showing that Japan actually sold more than China, which I found interesting.
Really? That is. Yeah. Well, think about this a little bit when you talk about financial warfare. I think there's a case study here that I don't know if it's applicable or not. You tell me. After World War II, I think it was Eisenhower, is probably in the White House. I don't remember who it was. I think it was Eisenhower. Britain wanted to take control of the Suez Canal. And so they took their tanks in there and they were going to fight to take that thing over. And so they asked the United States for their help. And Eisenhower, we just lost all these guys in World War II. We just dropped an atom bomb. I mean, we've got peacetime. And Eisenhower said, not only will we not help you, but you're going to get out of there because we hold all your sterling bonds from the war. We financed your war.
Yeah.
We hold all the sterling bonds. We will liquidate our sterling bonds. We will crash the pound. We'll kill your economy. Those tanks were gone in 2 weeks. So if you hold...
Well, not only that, they also said, oh, and by the way, we are now the world reserve currency. You had a good run.
Yeah, nice job. So now you look at China and the amount of U.S. debt they hold, it's not, but the difference is it's tough for China because they can't shoot themselves in the foot because we're their best customer.
Right.
Yeah.
So they need to maintain that money flowing to them, which is Trump's leverage. But, to your point, if the world decides they hold all this government debt and they decide to liquidate that takes demand for that way down.
Yeah.
There's a big supply. So what are your thoughts on that? Is that part of global financial warfare or no?
It is. I think China was in there and Japan apparently were in there selling bonds, which had an effect to drive rates higher because bond prices and yields go in opposite direction. And it really put the U.S. in a crunch. And I think that was one of the big shockers with the tariffs was not that the U.S. went after China, but that they went after everyone. They went after allies. They went after other countries, and they came after them in big fashion. And that was the shocker to the markets, was saying, okay, we're going to pump tariffs on everybody and do this dramatically. So I think the fighting between the U.S. and China was anticipated. It was all the other parts of it. But they're going to continue to use debt. I mean, that's one lever that China has is, hey, if we sell down the debt, it's going to pump their rates higher and it's going to put the U.S. in a little bit of a pinch.
It's an interesting back and forth. The other thing that I'd like, and we only have a couple minutes for this topic, but you think about tariffs as being inflationary and deflationary because there's elements of both. Mm-hmm. You say, well, it's inflationary in that you throw a tariff on something, they're just going to pass that on the consumer. That's inflationary. That makes us, and it's a different kind of inflation than just printing money, though. It really is a different kind of inflation. But it's also deflationary in that it slows down trade. And if you slow down trade, obviously free trade is it's better for the economy to have free trade than not.
Yeah.
So tell me about, does that put a lag on things, or does it even increase the inflation even more? Because when you globalize, that's deflationary, but when you localize, that's inflationary. But if you slow things down, that can be deflationary as well. Do you agree?
Yeah, and I think it's sector by sector as to who might be the beneficiaries and where it might be inflationary and where it might be deflationary. I think a lot of stuff is not coming back to the U.S. It's just not economically feasible. Yeah. And some things can. There are things that can come here. But the reality is you're not going – we export – I think 1/5 of what we import from China, roughly.
So they slap tariffs back on us, but we only export like 160 billion.
They don't buy our stuff.
So it's just not going to happen.
Which is why they went after the bond market. So
exactly, because that's a lever they have. Yeah. But we're not bringing back all those things, nor do we really want to, because the price of everything, like if we did, let's say that we just stopped today and everything we ship in from China, we started to manufacture here, it would be massively inflationary.
Yeah.
It would be out of control. And
we saw that in COVID a bit.
Yeah. It's part of the effect
you couldn't get things. I remember.
And so prices rose. Yeah.
I heard some patio furniture took 2 years because there was no iron. There was no steel.
Yeah. And so, and the prices are expensive. It's hard to get things. It's just one of those dynamics where you would actually go through the grocery store again and you'd be missing products if this trade war gets too out of control. Now China, another lever they have is on rare earth materials. They're saying, hey, we're going to stop shipping rare earths because that's a big thing in technology.
Hey, where we can get some of those? Greenland.
Yeah.
Oh my gosh, I knew that was coming. I wonder when that was going to happen.
See?
When were we going to go? That'll be another podcast.
As soon as Greenland and Canada become the 51st and 52nd state, then we'll have access.
Can you believe that? Unbelievable. Let's talk about practicality now. If we're in the eye of the storm, what are your plans for your portfolio, Noah? How are you going to trade this?
You mentioned earlier you're delta neutral. So
I sat out for the most part, partly because I've been busy too. Because I don't want to, and I'm not a day trade guy. I don't want to try and guess all that stuff. Kick my feet up, collect my dividend, collect my premium, go delta neutral. Not making money on the up, not losing money on the down, just sitting tight for me.
So I call that risk off.
And I don't want to sell because I don't want all the capital gain from all my COVID buyings that have doubled or tripled or whatever they've done. I'm not going to sell those for capital gain. So I'd rather delta hedge and just be delta neutral, beta weight everything out. That's what I'm doing eye of the storm because I think we could go a little lower here.
Yep. I have reduced some positions and I've got some in cash. So I've got some cash reserves. That's, I think, important to be able to deploy. And then just do delta neutral. I've got enough insurance to hedge off to the downside. And if the market rallies, it's not really going to benefit me much, but it's not going to, I just don't have to worry about trying to time things. And I do think there's turbulence ahead, and I think that there is going to be a tremendous buying opportunity coming down the pipeline. And so that's kind of I haven't heard Warren Buffett say he's buying yet.
Yeah.
No. Yeah. It'll be interesting to see what he says at the meeting coming up here.
Yeah.
Yeah, and I don't think he is buying aggressively at all. I mean, they haven't even been buying back their own shares, which kind of speaks to their value proposition compared to most of the S&P 500 is fantastic, and they've halted their own share buyback. So they're really loading up a cash hoard. My guess is that they've nibbled at a couple of things, but they're waiting for more downside, I'll bet, and so am I. I mean, with most of my capital. I pretty much have a rule, though, that I do buy something whenever that VIX is 50-ish. I just buy something because I'm like,
when the VIX is high.
When the VIX is high, it's time to buy.
They made a rhyme about it.
But I mean, it's just one of those things where, okay, what's the best value I can find? And I don't buy the S&P 500. I go and try and find the best value. What's a good PE, PEG ratio that I think is discounted?
What's bigger to you right now, PE or book?
Well, I would say it depends on the sector. If I'm trading financials, I really like book value. Because PEs are less meaningful. I bought on
some book value when Silicon Valley Bank.
We did. We were in Houston and we were talking about those financial stocks, and that was fantastic.
And so we just went and looked at book value, and I can't remember if we found some negative number, some really good numbers on that or
below
not.
1 type of numbers. Yeah, I
mean
they're still.
It'd be nice to pay 90 cents for $1 book value.
Yeah, for sure. I don't think they're quite as discounted as back in that crisis, but that was the last time.
Book value now, just wait a little bit.
Yeah.
Yeah,
they probably will be discounted, but
but book is your assets where earnings is going to change faster than the book, I would think.
For sure.
Well, and give us a quick definition of book value for the benefit of our.
In essence, it's adding up.
You're buying their balance sheet.
Yeah, their balance sheet is adding up all of the assets, everything it's worth, and saying what is that compared to the price. In essence, so it's a valuation metric.
I mean, you can look at cap rate, which would be, market cap. On real estate, market cap is the price times the shares. Enterprise value is the price times the shares, but integrating the balance sheet in there.
Yeah.
And so enterprise value is, I think, a better metric of what you're getting. So when you look at book value, you're saying, I'm buying this balance sheet. Am I going to pay $1 in price and get $1 on the balance sheet? Sometimes there's a 31 multiple on that. A 30 multiple where, you're spending $30 to get $1 on the balance sheet.
That's the tricky part with book value and that's why usually with the financial sector, it's really good metric. With some things that don't have, like technology companies are kind of tricky because a lot of times it's more intellectual type stuff. Like with Google, for example, Google doesn't have a bunch of machinery or assets that way. It has a mechanism that everybody goes to that and they can do advertising through it. And it's not capital intensive and it's not this and that, but they make a ton of money off of it. Well, book value would show very expensive because the liquidation value of that, it's like brand value. Well, you're getting something. They do
remove non-tangible assets from that number. So, for example, when Kraft Heinz got in trouble for, they said Oscar Mayer's worth whatever, and it turned out Oscar Mayer wasn't worth whatever.
Yeah.
Those are non-tangible values they put on things. So they do pull the non-tangibles out, but to Corey's point, there's a lot of IP and stuff that they think is tangible that you couldn't liquidate it. You couldn't liquidate as much. But financials, it's just their debt. Yeah. How much, what do they hold?
And below 1, I mean, if you have a book value that gets to like 0.5 and 0.4, I mean, it's
buying that asset.
Yeah, it's pretty good value there.
Yeah, awesome stuff. Well, be smart. If you haven't taken our armor class, take it. At a minimum, it'll show you what you need to learn. Is it a beginner level class? No, it isn't. But I've been recommending it to beginners so they can just know what they don't know.
Yeah.
And so they can look at that and say, well, gee, this seems pretty complicated to me, but at least I know now what I should start to learn and what I should start to work towards, because now I'm unapologetic in recommending people learn this because there's opportunity readiness in that armor, right?
Well, and I would make the argument it's not rocket science, but it's new. And so I think it's things that the average person can learn this stuff without a problem. If I can learn this stuff, I think anybody can learn this stuff.
You look at these YouTubers that play guitar, and it's easy for them because it's effortless. Like when I play the drums, I'm not the best drummer, but I can sit down in a band and, make my way and actually have fun doing it because it's easy. So I had an interview with a guy this morning, and we were talking about like writing a cash secured put. He goes, well, how hard is it? I go, well, it depends on who's doing it. For me, it's really easy. It takes less than a minute and bang, and off you go. But if you don't know what a theta is or a delta is or a strike price is or, how expirations work or how standard deviations work, it's a little different, So there you have it. Yeah. Great discussion, guys. Eye of the storm. Great time to get prepared. Never been more important time to get educated. We'll see if this is the eye of the storm or whether it calms or whether it really whips up and get fierce here. Time will tell.
It'll be exciting.
You've been watching and listening to the Cash Flow Academy podcast. Make sure you like, subscribe, hit your notification bell, and most importantly, remember, yourinvestingclass.com. At yourinvestingclass.com, free resources there, cool stuff to sign up for, absolutely free, and it can help you build a blueprint to take you from where you are now to where you want to be in the future. We'll see you next time.